I'm the fourth accountant, and here are the 10 things to avoid if you want to trade crypto. Number 1, chasing the hype or getting gassed on FOMO. FOMO is a very tempting mistress, especially when you see all the crypto bros turning small altcoin investments into holdings worth millions. But it is always important to remember that FOMO occurs when tokens are actively being pumped. By the time you will have heard of the token on your social feeds, people that have got in early will be dumping the same token.
How do we invest in it?
Huh?
How do we invest in it?
Well, you guys are going to get early access, obviously.
Getting caught up in FOMO is reactionary in nature and will generally mean you end up buying tokens at the peak of demand. This nicely leads on to number 2, panic selling. If you ended up buying tokens during a frenzied period of FOMO, chances are you will end up panic selling when the token price falls. Crypto token values are extremely volatile at the best of times, so understanding the fundamentals of the projects and the tokenomics is extremely important. The best way to avoid FOMO and panic selling is to proactively identify crypto investments or trading opportunities, and then, based on an underlying theory, buy or trade the token on that basis. Try not to get caught up in sentiment or emotion unless the viability of the crypto project itself is threatened in a significant way. Number 3, ignoring the fundamentals. As I have mentioned, proactive research of crypto projects, development roadmaps, tokenomics, and protocol utility is critical to ensure you are able to make sensible judgments about tokens to invest in or trade. You need to know what the token does and what it is for. When investing or trading, you have got to have a plan, because this will inform your decision to either go ahead or not, any risk management strategies you may adopt, and when to get out. In the case of crypto, I'm afraid this also means you've got to read the white papers. Number 4, failure to diversify. There are literally thousands of crypto projects and tokens at this stage, and it is very difficult to know which tokens will be successful and when. Even great crypto projects can fail due to incompetence, so having a diverse portfolio of crypto tokens is one way of managing risk. Ideally, token investments should be diversified across a number of different protocols based on different underlying crypto or blockchain technologies. However, this approach does not protect against a complete failure of the crypto sector as a whole. Number 5, not securing the bag. Self-custody and control over assets are key tenets of decentralized finance or DeFi. However, it is a double-edged sword because there is no one who can help you if your tokens are stolen or if you forget your wallet seed phrase, for example. Also, if tokens you own on a central exchange are stolen, neither the government nor the exchange cover the loss in the same way as banking losses. Basically, you are on your own. So ensure you understand self-custody protocols and how to use hardware wallets. Depending on your net worth, you may even need to consider protecting your seed phrase or ledgers in a secure banking vault. Number 6, not having an exit strategy. At some point, you need an exit plan, whether that be selling the token or transferring it to someone else. But when do you do this? This point ties back to the first 3 mistakes I've mentioned. Simply buying or selling tokens based on sentiment or advice from influencers without doing your own research will mean you will not know when you should consider selling any tokens you have bought. Ideally, a risk-based approach should be considered when deciding when to sell crypto tokens you hold. As token price is highly volatile and can drop almost instantly, it is worth considering taking some profit out of your token portfolio from time to time as a means of diversifying your asset portfolio. Number 7, ignoring tokenomics. Understanding the tokenomics of a crypto token project is critical to informing any investing or trading decisions. If you do not know what tokenomics means and you want to trade crypto tokens, then you better get to know. Bogus or dubious tokenomics is often a sign that crypto projects in questions might be a pump and dump and therefore best avoided. Number 8, not considering regulatory risk. There are a number of regulatory and legal frameworks affecting crypto projects, which may impact your ability to realize a return. For example, the Securities and Exchange Commission may classify any token receipts or yields as securities rather than assets, or initiatives such as the Crypto Asset Reporting Framework may mean you have to consider delaying selling tokens to avoid using up your capital gains tax allowance, for example. The point is that you need to be aware of these frameworks and the potential tax implications to maximize any potential returns. It is worth noting that in the worst case scenario, regulatory or government bodies can delist or ban particular tokens, which appeared to be a real possibility for XRP, for example. As mentioned previously, taking some profit from your crypto holdings and diversifying your portfolio of assets is one way to reduce your exposure to these risks. Number 9, just relying on price trackers and social media. Simply analyzing price charts or media slop will mean you are reacting to changes in sentiment or trading signals. This is not too dissimilar to FOMO or panic selling, which also tends to be reactionary and emotional in nature. Effective traders tend not to invest or trade reactively or emotionally. They are proactive and adopt risk management strategies in case they are wrong. When crypto trading, it is also important to view and analyze on-chain metrics such as the number of active users, total value locked, developer activity, token distribution, etc., as these metrics often show early trading signals. Metrics like these can be found on platforms such as CoinGecko, CoinMarketCap, DeFi Llama, and Token Terminal. And finally, number 10, forgetting about the tax.
Where's my money? You gonna give me my money? Where's my money, man?
If you receive or sell tokens, you have to consider both your income and capital gains tax obligations. In many countries, if you make money selling or even just receive tokens via an airdrop, for example, then you are liable for tax. Firstly, this means you need to maintain a record of all crypto transactions you have made and any gains or losses. There are a number of tools on the market such as Coinly, Accointing, or CoinTracker that can help you do this. It is also worth noting that crypto transactions are not anonymous and they can be tracked by the tax authorities such as HMRC. The Crypto Asset Regulatory Framework I mentioned is part of a wider global OECD initiative which requires exchanges to share trading information with the authorities. As such, if you are making substantial amounts of money trading crypto tokens or digital assets, it may be worth finding an accountant that can help you lower your taxes and keep more of your crypto profits.
So you've made it this far and you're now sitting on a pile of assets and a pile of cash. So how do you avoid all the tax associated with this? Well, the first thing you do is you do not sell the assets and you do not draw an income over and above any reliefs or allowances you may have. What you do instead is take those assets and you go to a bank and you borrow against those assets. And yes, there will be an interest rate associated with the borrowing, but it will be a lot lower than any tax liabilities you may incur if you sell the asset or if you draw an income over and above, as I said, the allowance. What you then do is use that interest, you use the loan to pay for anything you need to pay for, and also ideally acquire more assets, which you can then continue to borrow against. So basically you're compounding the borrowing, which obviously compounds the interest. However, if the assets you're acquiring are truly assets, they will appreciate in value, and that appreciation will be over and above any interest liability you're incurring, essentially. What you then do is you establish a trust, because what you do have to think about is an exit strategy, as I talked about in the video. Now, what this will allow you to do is pass on your assets and your wealth to any beneficiaries you have in mind. Now, this may be children, if you have any pets, or any vanity projects or charities or any monuments you're thinking about once you succumb to the sunken place. Now, when nature takes its course and you eventually pass on to the shadow realm, what then happens is the trust kicks in and then passes on that wealth to your beneficiaries. Now, the trust itself will be subject to tax, but again, it will be a lot lower than what it would be if you directly pass on that wealth to those beneficiaries. And then once your beneficiaries receive your wealth in in the most tax efficient way possible, they can rinse and repeat this whole exercise and your legacy continues. Enjoy.